I think that the disasters in the market are going to be more intense and happen more frequently. We don't, the duration between 2000 and 2008 is a lot longer than 2018 and 2020 and then 2020 to 2022. I think another problem is in 2024, and it's specifically when the RRP runs dry. That's the next catalyst. And when liquidity runs dry, boy, oh boy, that's when bad things happen.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin specials for December 11th through December 18th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have Silver Eagles at $4.99 over spot, making this a great time to swap silver bars into Silver Eagles at the lowest premium in years. Finally, Constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest back. Widely followed money manager Michael Pento is the founder of Pento Portfolio Strategies. He's joining us this Tuesday, December 12th, 2023. Michael, thanks for coming back on Liberty and Finance.
Hey, it's always great to be with you, Dunnigan.
You're getting a lot of exposure on many channels. I like to think that after the mainstream media booted you out, and we had you on here several times, that other people thought that was a good idea, so they've been inviting you on their channels. At least that's the way I like to think about it, because it's great that your insights are being shared more broadly, and I think that's a good thing for everyone involved. We wanted to pick your brain on where you see things heading right now, because it's confusing for many people. We hear talk of looming recession/depression. We're seeing some drop-offs in adoption of EV sales and different things that might affect major parts of the physical precious metals or base metals economy, etc. And we're wondering, people are always watching interest rates. They're concerned about the real estate market potentially rolling over here with interest rates having spiked last year, et cetera. Want to look at your view as you see it about what are the main trends you're seeing right now and the direction that those trends are taking us.
Well, first of all, I think it's interesting that, I started going on CNBC in 2006, and they needed some kind of like, a straw man that they can knock down. They said, "Oh, look at this idiot. He's coming on TV talking about a housing bubble and a recession." And I was on TV pretty much regularly all the way to 2011 or 2012. And my business didn't really kick into high gear until after I was summarily thrown off all major networks concurrently, simultaneously. I still don't know exactly why, but I think it's because I called the Federal Reserve a serial counterfeiter, but I'm not quite sure. That's just my own gut instinct. So yeah, it might being on channels like yours is far more lucrative and career building than being on I think they call it Bubble Vision. So thank you. Thank you for having me.
Yeah, it's bewildering because so many people are getting input and guidance from kind of this group think. And I was just reading an article in the Epoch Times this morning about how that affected some major policies that have affected all of our lives over the past 3 years. And very, very few people in that case, it was the medical community coming forward and apologizing that they fell victim into groupthink, and they weren't really basing it on fundamentals. They really weren't basing it on science. They really weren't basing it on the best that we could do or challenging assumptions, that sort of thing. But that's what you do day in and day out. You look at the data, you challenge assumptions, you look ahead, and you break out of groupthink to give people truly independent and active money management.
Thank you for saying that. This is a very artificial economy, Dunnigan. You understand. I think your audience viscerally understands it. We have a situation now where I believe that we need high interest rates, interest rates that are real, in other words, above inflation, to bring down inflation. But at the same time, if interest rates are high for very long, the federal government is insolvent. Think about that for a second. And I'm not trying to be hyperbolic here. I'm stating facts. Even Janet Yellen said today that it's an existential crisis for our fiscal future if interest rates stay high. But if interest rates don't stay high, it's an existential crisis for the middle class of this nation. So I just want to start off on that point. It's also kind of bothering me that there's a lot of FOMO out there, fear of missing out. It's as if, okay, forget about 2000 when the market lost 50%, S&P lost 50%, the NASDAQ gave up 83%. Forget about 2008 when the S&P lost over 50% and the home prices crashed by 33%. Forget about all that. Even fast forward till today, we have a very unstable and volatile regime here. 2018, the Federal Reserve had to promise to stop raising interest rates when they hit 2.5%. We're at 5.25%, 5.5% now, with a lot more debt and a lot bigger asset bubbles. But they had a promise to stop hiking interest rates. In order to stop the debacle that took place from October to the end of the year, down, plunging 25% straight down. And then fast forward, of course, okay, 2020 was a disaster the first part of the year where the S&P lost 30-something% in 1 month. That's because of COVID. Let's just excuse that. But what about 2022? In 2022, the S&P fell 20%. And I think 2024 is going to be another debacle. The Russell 2000 is down 25% since November of 2021. That's 2,000 stocks. That's not the Magnificent 7 AI stocks. I mean, outside of that, if you look at the average stock in the market, it's either pretty much in the flat area or down. We're only talking about 7 stocks here that have done anything. The KRE, which is the Regional Banking Index, that is down 17% this year alone. So there's a lot of pitfalls in the thought process of, hey, I'm missing out on something by not being bullish on the S&P 500, on CNBC, or even unfortunately on the American economy. You touched on it briefly about the housing market. This is a very tenuous situation we have in the housing market. I believe there's reasons to rationally conclude that the real estate market today is worse than it was leading up to the global financial crisis. So there's a lot of problems out there. That doesn't mean I'm a perma bear. You can ask my clients who I manage money for. I was very bullish at the end of 2020, did fine. 2021 was a great year for us going long the stock market. But for me now, I'm cautious. I'm still net long. I'm not net short the portfolio yet. I will come on and let you know when I see my proprietary financial conditions index tighten, when I see credit spreads start blowing out. That's when I'll know when to get net short. Still long, but I'm also cautious. The next step, I think, for this economy and this market is for a deflationary recession. Could be very deep, very damaging to the equity market. And we'll get more into that as the conversation proceeds.
Well, that's one of the things I wanted to bring up to you, because I speak every day and every week with clients who tell me that they are increasingly uncomfortable given the litany of risks that they feel in their gut or that they've heard from independent news sources are existing out there, such as the debt, the deficit, the banking strains, commercial real estate bubble, and residential, on and on and on. And yet, when they go to their traditional financial planners, they're told, oh, no, you just buy the dips and ride it out. Just stay invested, stay in the market, and it always comes back. And it's always the wrong thing to do is to emotionally overreact when there's concerns. That's when you want to stay in when there's concerns, and et cetera. Be a contrarian. Your view of how well that mantra of stay in and ride out the dips, which has worked fairly well for the past 40 years. Even when you were talking about those glorious 50 and 30% declines here and there, they're hard to see on a long-term chart sometimes when you see this monotonic slope upwards. But in your view, you said you think we're at the end of that regime, or it sounded like you were saying we're changing regimes. Do you see the next 40 years and the advice perhaps they should be looking towards as being different from what they saw for the past 40 years?
Well, yeah. Well, first of all, the 60-40 portfolio, as I like to say, is dead and buried, because when the Federal Reserve put the bond market and the equity market and the real estate market in a triumvirate of bubbles by taking interest rates to 1% or below for 11 of the past 14 years, from 2008 to 2022. That's what you get. I mean, if the real estate market is in a bubble, and if the bond market is in a bubble, and if the equity market is in a bubble, then guess what? Your 64 portfolio doesn't work so well. But here's the difference, right? Here's what happened since 1987 all the way to 2022. Actually, 2020, sorry. Whenever there was a problem in the economy, a hiccup in consumption, or whenever the stock market went down, the Pavlovian response from the central bank was to cut rates, because they had the cover to do so. Because what was the problem? The problem was inflation wasn't high enough. That was the problem. That was their mantra. I mean, I don't believe inflation above 0% is a very good thing. There's nothing wrong with a slight little bit of disinflation. That's wonderful, or deflation. But here's what changed. Post-COVID, we finally did something that we were promised would never happen in the United States, which was the launch of helicopter money. We were promised that the United States of America, with its world reserve currency status and its golden balance sheet, would never go down the road of borrowing or printing trillions of dollars and handing it out to people directly, bypassing the banking system, sending people checks in the mail. We did it. We did $6 trillion of it. Okay? So that led to inflation. Inflation was the problem. So now the next time we have a crisis, let's just suppose I'm correct. Just cede me that little slack here and say that 18 was a problem, 2020 was a problem, 2022 was a problem, and 2024 is another problem. What is the Federal Reserve going to do, Dunnigan, the next time there's a crisis? Are they going to, in a Pavlovian response manner, just cut rates to zero summarily? And are they going to launch some QE program? And is the Treasury going to announce a new round of helicopter money when the nation is insolvent? Are they going to do that with alacrity, expediently? No, they can't. They cannot. Because if they do that, they're staring hyperinflation directly in the eyes. Intractable stagflation at the very least. So that's the real problem. The salient issue now is the next hiccup. This is new. This is something we haven't seen in over 40 years in this country. We now have a problem with inflation. And that inflation demands an interest rate that is north of inflation. But an interest rate north of inflation bankrupts the Treasury. Now, if you don't want to acknowledge that, that's fine. If you want to go and call your broker and say it's time in the market, not timing the market, because most money managers are salespeople. They're asset gatherers. They're not economists. They're not market strategists. They're salespeople. And the mantra from salespeople is, hey, just buy and hold a diversified basket of stocks and bonds, and you will be fine. And for most of our lives, and even the lives before us, that was the case. But it's no longer the case because we have an artificial economy based on artificial interest rates that have built up and erected massive bubbles in stocks, bonds, and real estate, and rendered the amount of debt outstanding untenable under a real interest rate regime.
When you talk about manufactured artificial economy, artificial markets, etc., I can't stop thinking about Soviet-era communist command and control. That's what we were taught in junior high and high school and everything, was what made America great, and why everybody would want to leave Russia or leave China and come here was because those those command and control economies where the arrogance, the hubris of the top-down leaders would say, we can play God and we're smarter than the markets, and we'll dictate what the supply is, what the demand is, where the production is, et cetera, what the costs are. And I just read another article that was talking about the consortium of automobile dealers across the whole country, thousands of them, writing a letter to President Biden saying, please stop pushing this EV flood, this wall of supply on us. The EVs are piling up in their lots and they can't sell them fast enough. So yeah, they're not affordable. There's all kinds of 50 problems. And the only one thing that's going for them is this government subsidy. So your thoughts about the phenomenon, this new experiment, brave new world we're in America, where we think we're gonna be smarter than Mother Nature, smarter than free markets, et cetera.
Well, you said it perfectly, and I used the exact phrase you use. It's hubris and arrogance. That you know more, that any one cabal, group of individuals, knows more than the market. What's the market? It's the people having the power to vote with their wallet what they want to consume, what they want to produce, what they want to purchase. That's the market at work. In 1971, Nixon had a great idea. Hey, why don't we just completely break the gold window, and let's just have a completely fiat currency. That was wonderful. And then you have a tool in 87, when you had the 87 crash, Greenspan said, hey, we have a tool that we could use, which is just like, money is meaningless. We could we could monetize every problem away. Every time the market has a hiccup, print some money, lower interest rates, buy bonds, put the price of the bond higher, interest rates come down. And every time there's a hiccup in the economy, why should we have an unemployment rate rising? Dunnigan, you don't think it's good to have people on unemployment rate? That's not nice. We could fix it by just having a fake economy, an artificial economy. That's what we did. And we brought it to the extreme. In 1913, the formation of the Federal Reserve, they didn't even have a charter to buy government debt. They were supposed to be a lender of last resort at the discount window, where a bank would bring their assets to the window and get bailed out at a haircut, a severe haircut. Now the Federal Reserve is in the business of buying treasury bonds, corporate bonds, municipal bonds, anything is not nailed down. They will buy at full value. Look at the launch of the Bank Term Funding Program. Our problem is the banks own a lot of long-term government debt yielding 0.5%, but now it yields 5% or 4 or 5%. And that means the price is way, way underwater. What are we going to do? We're insolvent. Well, a snap of a finger, March 2023, this year. Guess what we're going to do? We will take all of your bonds, mortgage-backed securities, GSEs, I don't care what they are. We will buy them 100% face value, hold them for a year. Now, supposedly these assets are going back to the banks in March of 2024. I highly doubt that's going to happen because these assets are more underwater than they were when they were first handed off to the Federal Reserve. But that's the mentality is, we don't need to have a real economy. We can manufacture one, like a command and control socialist communist nation. But it's never worked anywhere else in the planet, and it isn't going to work here either.
And this has been proven not just in the arena of finance, but in other areas too. There's a book, The Really Inconvenient Truths. I suggest people check it out. It talks about areas where, again, through arrogance and well-intentioned, there's always a grain of well-intention there, was like, for example, to prevent forest fires, rather than allowing selective logging and clearing out of the forest, or allowing certain amount of burns to happen that nature always happens when there's lightning storms and that sort of thing. There was this idea that you put out every potential smolder. Wherever there's smoke, you go put it out, preserve, protect. And what you end up with is these tinder boxes, which have grown up to where now any conflagration would be magnitudes worse than what it would have been had it been done, through natural processes in the normal cycle of things. Just like you said, isn't it bad if someone's unemployed? Well, yeah, that's painful, but that's part of the healthy cycle of finding where the more productive segments of the economy to move into. Whatever. That's
creative destruction. It's creative destruction. I'll give you another a more tangible example. So isn't it a good idea that everybody owns their own home, Dunnigan? Would you agree with that? Isn't that nice?
The American dream. It's ensconced in the motto of the American dream.
It's wonderful, right? Well, how do you do that? Let's see. How would I do that? Well, let the market forces work, and freedom in taxes, low taxes, low interest rates, naturally occurring high savings rate, low inflation, stable currency. That's gonna promote a situation where the most people can own a home sustainably. No, we don't want to do that. What we're going to do is we're going to buy all of the mortgage-backed securities, bundled pools of mortgages, and take interest rates down to almost free. But a funny thing happened in the way of doing that. Home prices skyrocketed. So now buying a home is now 50% more expensive than just being a renter for the first time in history. So you've priced out the first-time home buyer. The road to hell is paved with good intentions. This is the result. Perfect example. Home ownership payments, which include taxes and insurance, are up to 46.4% of the median household income. That's a record high. Never before. So, some people might call me a perma bear, but if you had placed money with my firm, you would know that I am not. But what I am a perma bear on is the artificial construction and the complete abrogation of markets.
When you talk about the high portion of the household's income that has to go now to trying to sustain their ownership of their own home, which is, again, taxes are another part of that, because with those rising home prices comes scaling up of property taxes. They get reassessed. Well, your home's worth more. Now we're going to have to reassess your property taxes. That goes up too. And insurance, all these toxic side effects of the so-called well-intention of trying to buoy and support markets. It also has a toxic side effect on families because, for example, there was part of that American dream originally was you only would need one wage earner to support household ownership, and oh, by the way, you could have the parents actually taking care of their children and not teaching them crazy stuff too. But now you've got where parents feel that they have to have both working, and that's just to make ends meet, just to keep their nose above water. And so a lot of these, just like there was this so-called well-intended things about lockdowns over the past 3.5 years that had huge repercussions, even economically, psychologically, on and on and on, life expectancy and everything that was not taken into account. Again, the idea that a very small group of people can decide for everyone what's going to be their best life and dictate it to them. We didn't mean for this to turn into a philosophical discussion, but it sure seems like these decisions that are being made without our informed consent are rampaging through many parts of our lives, in addition to the economic parts of our lives.
It's very well said. I don't think I can add anything to it. We want to take it back to the markets. Wall Street is now 100% convinced that it's going to be a soft landing. So I'm going to take the other side of that. I think it's going to be a very hard landing. As a matter of fact, I'm in the crash landing camp right now. So for there to be a scenario where there is no recession, a lot of things have to be wrong that would have usually been very good predictors. For example, the yield curve has been inverted for about a year and a half now. It is the longest inversion of a yield curve in 43 years. 43 years is a long time. That's the longest and steepest inversion of a yield curve. Also, the index of leading economic indicators has to be wrong. The National Federation of Independent Businesses, their survey of business confidence, small businesses, that has to be wrong in order for us to avoid a recession. I just don't think it's different this time. I'm looking at these three reliable indicators. But there's a lot more. There's a lot more things that have to go right. And Wall Street has priced in an an earnings per share growth of 12% in 2024. Now, nominal GDP is crashing from 9% down to probably well below 5%. So I just don't understand how, even if I'm wrong about a recession, how in the world you're going to get a 12% growth rate in S&P 500 earnings when nominal GDP is less than half of it. It's just not going to happen.
Let's zero in on one portion of that, because you were mentioning before the Russell 2000 index, which is the broader measure than not just the top few market leaders. We've been hearing about zombie companies. You've talked to us about that in the past, which is a growing percentage of companies out there that not only aren't profitable when you consider that all of their income or more, all of their earnings or more, are going to cover expenses and debt. And so you've got now with interest rates in a higher position than they've been before, what do you see as far as if you're talking about a 12%, the market pricing in a 12% increase in earnings for the S&P 500, how is that going to be affected by the number of companies that are struggling to even make ends meet now?
Well, 40% of the Russell 2000 is unprofitable. And these unprofitable companies, guess what they have to do? They have to raise funds from the market. Their costs have already doubled since 2020. Their new funds that they're borrowing today will be double again from what they raised last year. So, and they constantly have to roll over their bonds. So this is very dangerous. And small businesses employ over 50% of people in this country. So when you go out and make your wild bets on a booming economy, like, it's just nauseating how I continue to hear the pablum, all of these people coming on CNBC and Bloomberg and the mainstream financial media tell you that, hey, the soft landing is virtually guaranteed. Put me on record. I'm absolutely 100% against that. I mean, you have to know, there are now 62% of Americans now living paycheck to paycheck. That's a record high. And they're paying a record high amount of interest on credit card debt. And that balance is at a record high. There's a 59% surge in corporate bankruptcies this year through November so far. That's better. That's more than all of last year's total, according to the S&P Global. These are not. I don't make up stuff. This is real information. There's $1.8 trillion of corporate debt that needs to be refinanced over the next 2 years, and that rate again, it's double than when it was just a couple of years ago. And you have to also believe that the real estate bubble is going to remain inflated, even though rates have surged for mortgages. So, I mean, listen, I am not net short in the portfolio. You might think that from hearing what I have to say that I am. I'm just not yet. Because amazingly, miraculously, the financial conditions are easing into all of what we're talking about. Still. Now, I'm going to answer the question why I think that's happening in a second. I just want to also say that credit spreads are tightening as we speak. So I'm looking at March, and please do not hold me to this date, because only God knows when this is going to turn. Right now, I'm net long in the portfolio, happy to be long in equities and some gold and bonds, primarily on the short end of the yield curve. But March of next year is when I think it's going to be time for phase 2 of the bear market, which is still firmly in place. We're still not higher than we were in November of 2021 and the S&P 500, even with the Magnificent Seven. Let me explain to you why I think March is going to be a big problem. And I hope I didn't say this on a previous interview, but if I did, it's worth repeating. Right now, there's a tremendous amount of liquidity coming into the market through the reverse repo facility. There was over $2 trillion parked there. Banks' excess reserves were parked there out of the economy and earning interest from the Federal Reserve. Fine. But the Fed started its quantitative tightening program And that has already drained about $1 trillion from the banking system. But that's being offset by the $1 trillion that's coming out of the reverse repo facility. 2.2, $2.3 trillion were in the RRP. Now it's 800 billion. According to the history that I'm looking at and the vector of the withdrawal, in March of 2024, the reverse repo facility will have about $200 billion left in it. And that's the minimum that it needs. And that means if the Fed continues with quantitative tightening, that's when you'll see financial conditions tighten. Because that 95 billion a month that they're draining is pure burning of reserves in the base money supply. That's when I think the stock market starts to fall, and that's when I think the economy starts to sputter too. So I am myopically focused on that time frame for when I think phase 2 of the bear market can resume.
We've got several questions that were submitted by viewers ahead of your arrival, and some of them I see tie into what we were talking about right now. First of all, I just want to give you an attaboy from Godek1 who says Michael Pento has the best data. If you're a data purist, you do care about the quality of your data. And I can tell from many conversations we've had together that it matters to you, and you don't just go off government statistics because you see that there's a lot of political influence on those rather than other sources of data to corroborate and cross check. But here's a question, because a lot of people have been concerned not only about the direct effects that you've been describing on banks and on savers and that sort of thing, but that there are houses of cards of derivatives built on top of a lot of these things that could cause further destruction systemically. Mark Fragola 6480 says, what could trigger a derivatives meltdown?
Well, I think you would have to have the bank term funding program expire and hand the complete 100% reserves back to banks. And then they would have these distressed assets, and the banking system would be insolvent. I think that's what you would need to happen. There's hundreds of trillions of derivatives. A lot of them are swaps. And I believe the problem in the swaps market would become salient if banks are under pressure because they have to regain control of their distressed assets. So that's what I'm going to put March 2024 on your calendar. That's the time when I think the stress in the banking system will become particularly salient.
A lot of what we've been describing is regarding the U.S. Policies of the Fed, the Treasury, the U.S. banks. Eli Voltari asks, in what country other than the U.S. would you hold assets?
The only other country now that I'm in and out of is India. Not that not that everything's perfect over in India, but it's got one of the highest GDP growth rates on the planet. If you do own Indian shares, you can't just buy it and hold it forever. So that's the only other country I find of interest right now. It's certainly not China, and Europe seems to be in this permanent case of sickness because of what we talked about before: command and control economy, socialist nations. Japan is a train wreck waiting to happen. So that's it. India.
It's interesting. I have a couple of good acquaintances and friends from my previous career who are from India, and they quipped with me that their country was doing better than most because they couldn't do a lot of the lockdown type stuff that was happening in some of the less populated countries. They said, for example, social distancing. They said if we all stood 6 feet apart, half of us would be in the Indian Ocean. So anyway, now regarding the Fed's actions, and that they've been kind of trying to drive this ship. And a lot of people have a murky idea of who actually pulls the strings at the Feds, who the real owners are, who the beneficiaries are. But Emery Mako 4063 asked, is the Federal Reserve Corporation an unauditable entity? Absolute power corrupts absolutely?
Yeah, I mean, you can, if you order the Fed that they're an insolvent institution right now, their assets that they hold are way underwater. But who cares when you have a printing press? Who cares about your solvent condition? And they can print endlessly. They That's their history. That's what they're going to continue to do. They have periods of time when they can fake it, where they say, hey, we're really worried about inflation. But when it comes down to it, the level of asset prices and the amount of debt outstanding demands that real interest rates be negative for this whole artificial edifice to stay afloat. So, you can audit them if you want to. I think Ron Paul was a big proponent of that. Never got it happen. Never had it happen. Even if you did, the conclusion would be, okay, yes, we are insolvent, but who cares?
That's one of the things, like when you mentioned the policy of buying up distressed bank asset bonds at par. It's like, how many of us wish that when a decision we make goes the wrong direction, we would just have a blue fairy show up and say, yeah, I'll take that stuff all off you at face value. Don't worry, we'll just do a do-over. Let's do a do-over.
Yeah, and it's not really QE. We're only going to buy it for a year unless they're still underwater, and then we'll just renew it. That's what I think is going to happen. But again, even if that's the case, you still have that reverse repo facility going to $200 billion by March. And if I'm correct in that timeline, it could be April, and it could even be before that. That's when all the liquidity leaves the stock market and leaves the banking system. And that's when the trouble will really pop up. I'm sure Powell's aware of that, but what is he going to do? If he cancels QE now and says that he's not going to keep interest rates higher in a real sense, he's going to have an unbelievable battle with inflation like he's never seen before. Imagine if he started QE again now. It's just insane. He's got it. This is what he has to do. He's going to continue to engage in quantitative tightening until we have a problem in the stock market. The average decline, I will mention, the average decline from the S&P 500 at the start of a recession, going back to data all the way to 1937, is 32%. From the start, we are not in a recession yet. So, and I think that figure could be generous, given how deep the recession could be, because Powell's hands are fettered this time due to the inflation problem.
Okay, so now we're getting to a point where I'm afraid we're going to start off where we've been in the realm of data, facts, economy, and stuff like that, and we're going to have to take a step into just a thought experiment. So we'll alleviate any pressure you might feel for being professionally accurate, because this is more of an opinion area. But there have been increasing concerning stories coming out about pre-announcements of a major disruptive, probably state-sponsored cyber attack that's going to disable markets, disable infrastructure, disable banking, disable whatever. And there are theories that would be an interesting, because when you get pre-announcements of big bad things going to happen, you wonder, what the heck? Who's in a position to pre-announce that this is going to happen? Although when you find yourself in a situation where there seemed to be this unresolvable collision of realities, where you say, we're really boxed into a corner, it's either going to be this terrible outcome or that terrible outcome, and look who created it, that it's helpful to have another enemy that you can point to and say, oh, that did it. COVID ate my lunch, or whatever. The lockdowns, whatever. It wasn't because all these businesses were in terrible shape and we were in a recession anyway. It was because we had to do this severe measures. So this question from Trevor Downey 6425 says, here's my question for Michael. What do you think the odds are of a major disaster occurring that wipes out the entire stock market, such as an EMP or cyber attack? And how long could assets be inaccessible? So we're not going to hold you to this as an economist or a money manager, just a thought experiment. Do you factor into your thought process something that would be systemically disruptive to the point of changing knocking the whole chessboard off the table?
Well, those fat tail events are certainly possible. I don't know how probable they are. But the way I come at this, then again, is, I have a few hundred million, couple hundred million under management here. And I have my own money under management too. So what good purpose would be served if I said there's a 13.7% chance of a electromagnetic pulse bomb being dropped on over the head of the New York Stock Exchange, and I can't get access to my money for 3 months. So what I'm going to do is I'm going to head into my bunker and watch, 9% inflation destroy my purchasing power and my chance of retirement. So I have a very logical way of thinking about this. I say, what I know and what I can mathematically model is scary enough. I don't have to worry about World War III or some kind of massive cyber attack, which is unknowable. It's a danger, but it's unknowable. So what I can tell you this, the model I created, the inflation, deflation, economic cycle model, is built to understand what the insiders know and what they act upon before Wall Street knows about it, before CNBC gets any clue. So, for example, in 2020, in January, my model started detecting something that was wrong in the arcane components I looked at in financial conditions and credit spreads. And at that time, COVID was just there's some kind of virus in China. I don't know if it's the bubonic plague or is it sniffles. Nobody knew, but we knew there was this novel coronavirus out there. But the model said this could be something very serious, cause didn't specifically predict lockdowns and all the others, mask wearing and the no travel. It didn't predict, but it understood that the medical field and the business leaders, the government of China was concerned about it enough to start acting on things, starting to buy protection, which my model picks up on. So I reacted to it and actually did very well the first quarter of 2022. Didn't lose any money then, which was unusual because that's when the market dropped 30% in a straight line in 1 month. So let's suppose China was going to invade Taiwan in November of 2024. The generals in China know this. They will act upon it before it occurs. They will preclude their actions. I'm sorry, not preclude. They will front run their actions by buying gold. They will short the S&P 500. They will buy certain derivatives, that will go up in price as the market tanks. So certain spreads. So the model is looking at that and will understand it. So when the question is, well, Michael, will how much are you worried about this cyber attack? I don't know when it's going to happen. It could happen, but if it's planned, I will know a few weeks ahead of it because the insiders always make money on it.
It's distressingly fascinating, but glad you've got your eyes on these leading indicators and glad that we have you here helping us to see what most people aren't being able to see. And if people want to specifically take advantage of your full services as an active money manager, where should they go?
So the website is pentoport.com. And if you're a U.S. citizen and you have $100,000 to invest, that's the minimum. And if you don't have that, that's fine. I mean, you should subscribe to my podcast. It's $50 a year. You'll get a lot of the data that I look at, and you can draw your own conclusions. I won't manage the money for you, but you might be able to draw your own conclusions as to what you think I might be doing and what I'm buying. It's a free 5-week trial. So, either way, in either financial situation, I have something to help you hopefully navigate what I think is, I always say this is like birth pangs. They come with greater intensity and more frequently. I think that the disasters in the market are going to be more intense and happen more frequently. We don't, the duration between 2000 and 2008 is a lot longer than 2018 and 2020 and 2020 to 2022. I think another problem is in 2024, and it's specifically when the RRP runs dry. That's the next catalyst. No more liquidity, market way over its skis price-wise, anticipating 20 times 2024 earnings that are going to be, 12 times 2024 earnings of $245 a share. 12% growth. It's just not going to happen. And when liquidity runs dry, boy, oh boy, that's when bad things happen.
Well, every time we have you on here, we have people say, why don't you have Michael on more often? Or, gee, you should have this guy back. We've never heard of him before. So either way, folks, if you don't want to miss a single episode with Michael, whom we have on here approximately once a month, make sure you sign up for our free newsletter at libertyandfinance.com. Just go to libertyandfinance.com, put in your name, your email address, click submit. Make sure you confirm on the confirming email, and you'll get one email in your inbox per day. We don't sell your email address to anyone else, and we won't miss a single episode with Michael or any of our other guests and our weekly specials. Michael, as always, we appreciate your presence here with us, and glad we have you in our corner here on Liberty and Finance. Thanks for joining us.
Blessings to you, and have a very wonderful Christmas.
Blessings to you, and blessings to your family. Wonderful Christmas and New Year's to everyone. We'll look you up again in the new year and check in on how things are trending. And thanks for being with us.
Thank you, Donnie.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.